All right, let's talk taxes. Look, for most of us, it boils down to two things, right? How do I save the most money, and how do I make this whole process less stressful? Well, you're in luck. Today, we're handing you the playbook to do just that. We're gonna break down the two biggest decisions pretty much every single taxpayer has to make. So let's get right into it.
So let me ask you something right off the bat. Are you sure you're not leaving money on the table with your taxes? I mean, really sure? Because every single year, millions of us make a choice that literally changes the size of our refund or what we owe. And believe it or not, it all hinges on one simple decision. And here's the thing, this choice isn't hidden away in some super confusing tax form. Nope, it's really just about picking one of two paths, both designed to lower the amount of income you get taxed on. But before we get into what those paths are, let's just do a quick reset and make sure we all know what the main goal is. Okay, so what's a tax deduction? Think of it like a discount on your income. It's an amount you get to subtract from what you earned. And the smaller your income looks on paper, the smaller your tax bill is. So our goal, the whole point of this game, is to make that discount, that deduction, as big as we possibly can, legally, of course. And that brings us to the very first big play in our playbook. This is your first major choice. Are you going to go with the standard deduction, or are you going to itemize? You have to pick one, you can't do both, so making the right call here is, well, it's a really big deal. So the standard deduction is exactly what it sounds like. It's the simple, straightforward option. It's a flat dollar amount the IRS says, here, you can take this much off your income, no questions asked. The amount just depends on how you file. So for example, for the 2025 tax year, if you're single, you get a $15,750 deduction. If you're married and filing with your spouse, you get exactly double that. It's designed to be easy peasy. Now, on the other hand, you've got itemizing. This is the opposite of the simple fixed amount. Here, you're basically a detective. You're adding up a whole list of specific expenses that the IRS says you can deduct. We're talking about things like the interest you pay on your mortgage, state and local taxes. You'll hear that called the SALT deduction. Any big charitable donations you made, or, if you had some significant medical bills. All these little things can really add up. Okay, I know what you're thinking. Itemizing sounds like a huge headache. But honestly, it's not as scary as it sounds. H&R Block really hits the nail on the head when they say the whole decision just comes down to simple math. You don't need to be a CPA for this, I promise. All you really need is a calculator. All right, let's prove it. Let's run the numbers with a super quick example. This is going to make everything click. Okay, so let's say you're filing as single, and you've done your homework, you tracked your expenses, you had some mortgage interest, you gave some money to charity, you paid your state taxes, you add it all up, and boom, your total for all those itemized deductions comes to $14,000. So that's option A. What's option B? Well, remember, the standard deduction for a single filer is $15,750. And here's the big reveal. You just pick the bigger number. That's it. In our little example, $15,750 is obviously bigger than $14,000. So you'd take the standard deduction, no question. You'd get to subtract an extra $1,750 from your income. It really is that simple. So who should actually bother doing this math? Well, here's a good rule of thumb. If you're a homeowner with a mortgage, or if you had really big out-of-pocket medical expenses, or you were very generous with your charitable giving, those are huge signs that you should absolutely take 5 minutes, add up your itemized deductions, and see if you can beat that standard number. Okay, playbook page turn. Let's switch gears to another huge source of tax stress. What happens if your problem isn't which deduction to take, but the fact that you missed the deadline completely? Ugh, that sinking feeling. It happens to the best of us. But listen, the absolute worst thing you can do right now is panic. There's a playbook for this too. Okay, this next part is something that most people get completely wrong, and it's so important. The IRS has two main penalties, and there's a massive difference between them. The penalty for failing to file is a whopping 5% of your unpaid tax bill every single month. But the penalty for failing to pay, it's just 0.5% per month. Let that sink in. The failure to file penalty is 10 times worse. That's the one that's a real killer. And if you need another reason to get moving, if your return is over 60 days late, the IRS slaps on a minimum penalty. It's either $525 or 100% of the tax you owe, whichever is less. The bottom line is, they're not messing around. They want that paperwork, and they want it now. So this brings us to what might be the single most important piece of advice in this whole explainer. The biggest mistake you can possibly make is thinking, I can't pay, so I won't file. That's backwards.
Even if you owe thousands of dollars and you don't have a single penny to send them, you have to file your return. Just getting it filed stops that brutal 5% monthly failure to file penalty dead in its tracks.
Okay, so you get it now. You missed the deadline, but you understand filing is priority number one. So what's the game plan? How do you minimize the damage? Let's open up the penalty reduction playbook.
Here are the 4 things you need to do, like right now. Step 1, file that return, ASAP. That stops the big, scary penalty from growing. Step 2, pay whatever you can. Even a small payment helps reduce the balance that they calculate penalties on. Step 3, this one's a pro tip. If you've been good about filing and paying for the last 3 years, call the IRS and ask for a first-time penalty abatement. Seriously, they'll often waive the penalties as a one-time courtesy. And finally, step 4, set up a payment plan for whatever is left.
And the good news is, the IRS can actually be pretty flexible. They're not just looking to crush you. You can set up a short-term plan to pay everything off within about 6 months. For bigger amounts, you can get a long-term installment plan that stretches out for years. And listen, if you're in a really tough financial spot, you might even be able to get what's called an offer in compromise, which could let you settle your tax debt for less than the full amount you owe.
Okay, but what if all this panic is for nothing? What if you missed the deadline, but the government actually owes you money? Well, here's the best news you'll hear all day. There's no penalty for filing late if you're due a refund. They're not going to punish you for not taking your own money. But there is a catch. Don't wait forever. You only have 3 years from the original deadline to file that return and claim your cash. After that, it's gone for good.
So there you have it. That's the Smart Filer's playbook. You know how to make the right call on your deduction, and you know exactly what to do and what not to do if you miss a deadline. The knowledge is yours now. The only question is, what's your next move?